Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by Chairman and Chief Investment Strategist of the firm, Jason Trennert. Jason, how are you doing today?
I'm doing great, Ross. How are you?
Doing very well. Thrilled to talk to you. And I want to start with a theme that you've been talking about for quite a while and just kind of get your update on it, which is number one, that even if inflation comes down, it will remain kind of above the pre COVID trend or the trend of the last decade. And then two, that pairs with one of the greatest risks to the market being that the Fed will have to tighten more aggressively than is priced in. Where we sit today, I'm just wondering how you feel about those two in conjunction with each other.
Yeah, as far as inflation is concerned, I do think there's a more structural nature to it now than we've seen in the past. And there are a number of reasons for that. I think the most important one is the fact that we've entered a period, in my opinion, of deglobalization. That globalization really started with the fall of the Berlin Wall and then picked up speed when China joined the WTO. And really a good portion of the global economy was built on the disinflationary forces that globalization ushered in. Unfortunately, I think now this idea, this hope that the more trade we would do with non-Western countries would make them more Western, I think has turned out to be false. And I think as a result, certainly after the pandemic, there's going to be a strong tendency to try to do more manufacturing at home, which is a good thing, or do more manufacturing with friendly countries that perhaps might be a bit closer. The only issue with that is that is a very meaningful change in terms of inflation, a long-term change. The other things that we're looking at as far as inflation that are somewhat more difficult to squash, if you will, would be the labor market, where you still have twice as many job openings as you have people who are unemployed who are looking for jobs. We think that's going to continue to put upward pressure on wages. I'd also say that rents, if you look at homeowners equivalent rent, is something that's likely to stay sticky, just to the extent to which housing prices are up 20% year over year. Housing prices tend to lead rents. And again, I think that's going to be sticky. Having said all that, and then there's energy, where I think, unfortunately, in the West, we have largely adopted environmental policies without having cogent or well thought out energy policies. And I think that's going to be a reason why the price of oil and natural gas is likely to stay higher longer. Those are all things that are difficult to I think, eliminate quickly if you're the Fed. And it's one of the reasons why we think the Fed is probably going to have to, in Powell's words, keep at it, is going to have to continue to tighten at least until they feel as if there's some slack in the economy, particularly in the labor markets.
Yeah, I think that makes a lot of sense, and it does seem that we have a ways to go on that front in particular. I want to get your thoughts. So everybody knows about interest rate hikes; they get a lot of coverage. You all have started to write a little bit more about this, the idea of quantitative tightening, which is kind of the Fed's other lever to pull on, just to tighten policy. It's a bit, it's a bit more idiosyncratic. It's harder to understand, but I'd love if you could kind of lay out, basically in layman's terms, what quantitative tightening is, or what balance sheet runoff is, and how you think it would impact everything from fixed income to equities. You wrote a great piece earlier in the week on this topic, and so I'd love if you could expound on it a bit.
So the assets on the Fed's balance sheet, and just like assets on any bank balance sheet, are loans. And just to give you some context, the assets on the Fed's balance sheet were $800 billion before Bear Stearns failed. They were about $4 trillion at the start of the pandemic, and they're now $9 trillion. So it gives you a sense of how easy the Fed has been in terms of their willingness to either buy bonds or make loans. Same idea. Now, because inflation is an issue, they want to see the size of their balance sheet, or the amount of loans that they've extended to other people. They want to see that start to decline, because they are fearing that it's contributing to inflation. In the second half of this month, September, you're probably going to start to see about $95 billion a month decline from the Fed's balance sheet. which is about $9 trillion. So it's not a lot, but it is important at the margin because that is levered and it's out in the system. So it's something that we're not quite sure, and I don't think the Fed is quite sure either. They've been pretty clear about that, what impact that will have on the real economy versus what impact that might have on financial markets. At the margin, though, the most important thing to know is that it is a form of tightening. And so it is another tool. In my opinion, the Fed is going to use Fed rate hikes, interest on excess reserves, to control inflation more than it's going to use balance sheet declines. But by the same token, Ross, I think they've come to the conclusion that they're providing a little too much liquidity to the market, which is making their job a bit harder, and they want to rein that in a bit.
Absolutely. Well, I appreciate that primer. That makes a ton of sense. And I think if we could sum up everything, it's just that the environment we're in today, tighter financial conditions, higher interest rates, is set to persist at least in the near future. And so hopefully we'll get to have you back on sometime when that's coming to an end to talk about what's next. But Jason, thank you so much for the time today. It's been very insightful, and talk to you soon.
Thanks a lot, Ross. Anytime.